Hi everyone. In this video, I would like to talk about risk assessment. So auditors are responsible for assessing both fraud risk and inherent risk related to each relevant assertion for each significant account or disclosure. So what does that mean? That means they're going to start by looking at your trial balance and they're going to scan through and look for what accounts are significant or material. What disclosures do they think are significant or material to those users of those financial statements? And then they're going to say, okay, what assertion is most likely related to this? And then they're going to assess the risk for those ones that they have identified. When it comes to fraud risk, that's a special case of risk of material misstatement related to earnings management or the intention of management to mislead the marketplace by issuing fraudulent financial statements. So all of the big fraud cases that you've heard about, we're going to have to assess the fraud risk that we might have something like that going on within this organization. And that fraud risk can be related to three different factors. So the first is management's characteristic and influence. So if you have a manager who's overly involved in the day-to-day operation of your accounting program, your accounting department, and how things are recorded, and is issuing overrides when they probably shouldn't, that's an indicator that we might have some management overstepping where we could have some additional fraud risk. We could also have some industry conditions that would prime us for fraud risk as well. Maybe we're in an industry that is declining, or an industry that's highly tied to the economy that we are operating in, and we're in a recession. Those would be examples where there might be some incentives to manipulate the financial statements. Also, operating characteristics and financial stability. So if we are in a highly volatile company, again, we might want to smooth things out so we can just make it to the next bond offering or the next stock issuance so that we can get an inflow of cash and make it through. Going back to management characteristics and influences, maybe analysts have projected that our stock is going to be at a certain level and our financial statements are going to come out at a certain level, and they've given us some benchmarks that we're not planning to be able to hit. Are we more likely to just put it out there what it is, or are we going to play the game and try and hit those benchmarks? Maybe our CFO and CEO have compensation plans that are tied to their stock prices, and they don't want their stock price to go down. And if we don't hit those industry benchmarks, that's exactly what's going to happen. Those, again, would be conditions that might lead us to think that there's an incentive there for management to kind of cook their books. The second type of risk assessment that I want to talk about in this video is our inherent risk assessment. So remember, inherent risk times control risk is going to give us that risk of material misstatement, what we think is happening within this organization. And again, inherent risk is that probability that without internal controls, errors or fraud could enter the accounting system and be used to create those financial statements. So we have to think about all of the different things that can go into that inherent risk and what could come out the other side that might make those financial statements materially misstated. So when it comes to our inherent risk, there's a number of different things that we might want to think about. So when it comes to this inherent risk, the factors that we might want to think about are things that would make us more susceptible to misstatement or fraud. So for example, the size of an account. So like I said at the very beginning, we're going to look at the trial balance and we're going to scan through and we're going to identify accounts that are material, because those are the ones that could ultimately have an inverse or a negative impact if there's a misstatement in there on those financial statements. We're also going to want to look at liquidity. So if our current assets are less than our current liabilities, meaning we're not thinking we're going to be able to make our pay off all of those obligations, that's an increased risk for this organization. So that would be an increase in our inherent risks. The number of transactions. Certain accounts are going to have more transactions running through them than others. Those that have higher number of transactions are going to have higher levels of risk. Complex transactions. So maybe we can look at how things are recorded, look at how things are estimated, and if it's really complex, that's going to add a layer of risk there. The last one, subjective estimates. So some things are pretty clear in black and white, and other things might require some subjective or professional judgment. When we have subjective or professional judgment, you're going to have people who have disagreements. So maybe the auditor thinks something should be recorded at 5% and the client thinks it should be recorded at 10%, whatever the case may be. Because we have these differences of opinion, there's different levels of risk there. I'm going to talk in the next video, about this risk assessment process, so stay tuned for that.